Good evening, everyone. Welcome to our UC Riverside Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. We have quite a large sign-up list for tonight's class, so I'm going to allow everybody to get into the class, get settled in, and then we'll get started. We're really excited to bring this content to you. Our runtime for tonight's class is just about an hour. So the way we run our sessions is we're going to interweave kind of questions from our audience that come in. We'll answer those questions on air, but I'll also carve out some time at the end of tonight's class to go through any questions that we got kind of left behind, and really kind of open it up for overall Q&A. We're really excited in our partnership with UC Riverside. We've been in partnership for the last 5 years. We bring this content to the Alumni Association usually 4 times a year. So once a quarter, we host classes like this. So if you enjoyed tonight's class, we'd love for you to share that with your friends, family, maybe your coworkers that are also thinking more about kind of what home buying could look like for them. And I think, you picked a really good time of the year to have this or be a part of this class, because there's a lot going on economically right now that we want to be able to kind of share with you and how that could potentially impact home buying for you. And then let me just quickly check in the chat. Okay. All right, perfect. I saw some messages in the chat. Want to make sure we're good with that. And then I just want to kind of let you know, we are recording tonight's class, so we'll have this up on our YouTube channel tomorrow morning. We're also going to be able to send out all the presentation material to you as well. All right. Well, again, I appreciate you taking time out of a busy Tuesday evening to join us for tonight's class. So let's kind of dive right in. Just tell you a little bit about me. So again, my name is Jason Maida. I'm going to be your presenter this evening, and I got a chance to work with you in building home buying plans for you. So like after this class, if you're thinking about maybe being on that path or getting on that path towards home ownership, I'll be working with you one-on-one to help create a home buying plan for you. So I specialize in first-time home buyer programs, and I get a chance to facilitate classes like this all across the country. So we work in multiple states, California being kind of home base, but we get a chance to present similar classes like this all across the country. Well, as I mentioned earlier, you picked a really good time to be in this class, because we're going to talk a little bit about the housing market, what's going on with the market, what's impacting interest rate, or what does the interest rate environment look like. We're going to spend some time looking at a budgeting exercise. So I want to kind of walk through what a budgeting calculator looks like for you. So if we were to continue renting for the next 7 years or so, what could that look like versus me deciding to buy? We'll give you some tips around credit. We'll look at student loan documentation or student loans and how those can impact your qualifying. We'll talk about loan programs. We'll spend some time looking at income scenarios, as well as down payment assistance programs to help you and support you in home ownership. And then finally, we'll kind of wrap up tonight's class looking at the buying process. So after tonight's class, I may say, hey, you know what? I want to really design a home buying plan for myself. I might not be buying in 2024, but it's really a goal of mine in 2025. We're going to show you how to get on that path towards home ownership, and then really what the process will look like for buying. All right. Well, again, I appreciate you joining tonight's class, and we're going to dive right in. I know we have a lot kind of with the top of the hour, just being past the top of the hour. We'll have others joining the class, but we'll allow them to catch up. Again, this is a very interactive session, so if you do have a question, go ahead and use the Q&A function in Zoom. We'll answer those questions on air, or if it's easier, we can manage that through the chat as well. All right, so when we think a little bit about buying, when you make that decision to purchase, it's probably going to be one of the biggest financial decisions you decide to make, right? This is a big deal, and the fact that each of you in tonight's class are taking time out of your busy Tuesday night schedule to join a class obviously helps you understand the magnitude of this decision. And I think it's important to understand the different benefits that come along with owning a home. Well, first of all, you're able to create kind of more fixed housing costs when you own a home. You're not worried about a landlord that's increasing your rents on an annualized basis. The home will hopefully appreciate over time. So as your home goes up in value, as you continue to pay down the balance of your mortgage balance, the difference between those numbers is called home equity. And that's probably one of your number one sources of wealth. In fact, home equity can also create generational wealth that you can pass along as an asset to heirs of your estate. And when we think about home buying or ownership, it's not necessarily an apples to apples comparison, because guess what? There's a lot of great tax benefits that come along with owning a home. So one of the things we like to do in our classes is to kind of kick off our class by looking a little bit closer at a budgeting exercise. It's really a rent versus budgeting calculator. And as I mentioned earlier, all the material that we share with you this evening, we're going to go ahead and pass that out to you in email tomorrow. But I always like to, in our classes, to kind of walk our class through what this budgeting tool looks like, so we can really kind of frame up for that path of renting versus what it looks like on the ownership path. So let's kind of take a quick look at this calculator, and I'll kind of explain to you how this works. By the way, this calculator is brought to us by Freddie Mac. You're going to hear more about Freddie Mac a little bit later, but Freddie Mac has this calculator tool on their website, and we obviously use it for our presentation with our classes. So let's take a look at how this calculator works. So we're going to make an assumption that we're paying rent at about $2,500 per month. We have renter's insurance at $15 a month, and then we assume that our rent's going to go up about 5% on an annualized basis. So that's on the rental side of things, right? Now, I do realize for those of you that are kind of tuning in tonight's class, your housing costs may vary depending on where you're at, whether it's in California or any other state. But, I would encourage you to take some time, use this calculator yourself, and kind of run through your own formulas and see what that looks like for yourself. Now, if we build out the home buying side of things. So let's assume we're going to buy a house for $650,000. We have a minimum down payment of 3%. And then we have other expenses on a monthly basis, like our property taxes. We have homeowners insurance, potentially maintenance costs of our home. So those all go into kind of the home buying side of the ledger. And then from a loan information perspective, generally we're going to have a 30-year fixed mortgage. So that means our payments are fixed for the next 30 years. We have an interest rate assumed at around 6%. We're going to talk more about interest rates in just a bit. Then we have origination costs. So that's what a lender will charge you for the cost of your financing. Now, one of the good benefits, or great benefits, I should say, with being part of the UC Riverside alumni is we actually discount origination charges by $750 for our first-time buyers. All right, and then there's discount points that is an optional expense for buyers, and that allows a buyer to bring down their interest rate level by paying additional funds out of pocket. And those are called discount points. Discount points are generally 1% of your loan amount, and that 1% of your loan amount translates into cash out of pocket. So if I'm financing, let's say $450,000, that means my upfront cost would be $4,500. And generally that 1 point cost will bring down your mortgage interest rate just about 0.25%, give or take. All right. Now, in today's market, I don't really recommend paying discount points. The reason for that is because there's about a 3 to 4 year break even on those investments. And most buyers that are really getting in today's market, maybe this year, even next year, are probably going to refinance in 1 to 2 years down the road. So with a break even of about 3 to 4 years, it really doesn't make a lot of sense from a discount points perspective. All right, and then we have other settlement services. So in California, that would be like title and escrow fees, transfer taxes. Those are going to be all part of closing costs and what we call as prepaid items to purchase a home. We generally recommend that first-time buyers or buyers in general budget about 2 to 3% over their overall sales price for the closing cost expenses. So you're going to hear me talk a lot about savings tonight. So when we're thinking about saving for home ownership, we have to save up for our down payment. We also have to save up for closing costs and prepaid items along with purchasing a home. Now, the last section is our other assumptions in our calculator. We're going to assume the home's going to appreciate about 4% on an annualized basis. We're going to factor in how long I'm going to be in this house, which we have it at 7 years, the cost of selling my home at some point in time. We have the state and federal taxes, and then finally the savings rate. So if we first click on our kind of our payments tab up here, taking that leap into homeownership is going to elevate our costs from $2,500 a month up to what, $5,200 a month right now. So that's a huge jump, right? So I think it's important to understand as a buyer that while it's going to be an increase in monthly outgo, as long as it's affordable for me, my upside of owning in terms of total cost opportunity over 7 years in comparing 7 years of renting versus 7 years of buying is about a $48,000 opportunity. Now, the question is, how do we get to that $48,000? Well, that's attributed to tax savings of owning, but also the big part of that is also going to be appreciation of home over those course of the 7 years. Now, as I mentioned earlier, a lot of clients that are buying in today's market will probably refinance as rates start to more normalize. So this number could be much better than $48,000, certainly if I'm paying at a lower outgo. But in today's market, that would be the opportunity of renting versus buying. So as you're considering home ownership, I think this calculator does a really good job of framing up what it could potentially look like for you. And again, going back to my analogy, it's really not like an apples to apples comparison when it comes to renting versus buying a home. All right. So let's talk a little bit about the housing market. So there's a lot going on in the housing market. And, I teach classes all across the country. And the market looks very similar. I would say Riverside County is a bit different because we're seeing a lot of migration into Riverside County, especially from a lot of LA County buyers, just because of affordability challenges. But the market looks very similar in most parts of the country. Now, the median price might look a little bit different, but the trends in the market that we're seeing here are pretty similar. Now, in today's housing market, we've kind of got a late start. And what I mean by that is, generally most first-time home buying or buying in general is really starts to ramp up in April and May when the weather starts to get a little bit nicer in most parts of the country. But we've seen a little bit of a delay and a late start in buying. A lot of that is kind of just a little bit of concern on the consumer side. Where are interest rates going to go? Are prices going to fall? What's happening there? Is there inventory levels available? All those questions I think the average consumer is asking right now. But in July, August, and now we're into September, the consumer really is showing a lot of motivation to buy now. And I think that's just because, what we're seeing with interest rates, which we'll talk about in just a second, interest rates are trending down. And as interest rates trend down with only so much inventory, buyer demand and prices will generally probably go up. So I'm starting to see a little bit of more urgency in the buyer's market. And so when we look at markets like Riverside County or San Bernardino County, where they tend to be a bit more affordable than, say, LA or Orange or San Diego County, you're starting to see not starting, but you continue to see ongoing migration into those markets. So I think the question is, what does our housing market look like, especially as we're going into the fall and winter months? I think it's going to be a lot different than we see in historical markets, where generally it starts to slow down a little bit in the fall and winter months. I think with what we're going to have on tap here with the interest rate changes, you're going to see a lot of buyer demand come up. The question is going to be, is there inventory to support our buyers? Because again, if there's only so much inventory, buyer demand pushes up, we're generally going to see prices start to rise as well. So when we think about interest rates, we're looking at an interest rate market that we're starting to see interest rates come down, especially from the peaks that we saw in October of 23, where rates reached 8%. So that obviously changed affordability massively. But we've seen kind of this bumpy ride here for most of 2024. But as of the last probably 4 to 5 weeks, we've started to see rates starting to come down. Now, why is that the case? Well, let's first back up for a second and talk about how we got here from this higher rate environment. Well, the Federal Reserve has tried to combat inflation by elevating the federal funds rate. So that's what we've seen over the last couple of years. And, obviously the 8% rate was the highest we've seen in the last 20 years in rates. But rates have continued to come down. And the reason for that is because inflation is starting to cool. But there's also some additional concerns in the economy, which is that the labor markets are struggling a bit. And so the Federal Reserve is going to be meeting on the 18th, which is next week, for a potential federal funds rate cut. Well, there's a pretty good chance that rate cut's going to be about a 0.25% cut. There's about a 25% chance it's going to be a 0.5% cut. And I think that's important to understand as a class, because that necessarily won't translate to lower interest rates by a 0.5% or 0.25%, but it does immediately change borrowing costs of credit cards, personal loans, auto financing, but it will also have positive impact into the mortgage space as well. And so that's where we're already seeing the hints of a federal funds rate cut coming, already impacting interest rates. So interest rates have fallen to about 1.5 year lows right now. We're hovering around that 6.25 range. And so we'll hopefully see rates continue to go down a little bit. I don't know if we'll go much lower than 6.25, but we'll probably stay in that 5.8 to 6% range. So a really encouraging sign as we move forward. But I think it's, again, important to understand that even though we see that federal funds rate cut probably next week, it's not necessarily going to translate directly into mortgage interest rates. We will see some flow into interest rates as we see kind of the market hopefully start to soften overall in interest rates. Now, interest rates on mortgages are not the same for all buyers, and I think that's important to understand. There's various characteristics that go into the makeup of an interest rate, like credit eligibility, the type of product that I'm going to elect, how much I decide to finance, what my down payment might look like. For our those that were joining us earlier, we talked a little bit about discount points where you have the option as a buyer to pay additional funds out of pocket to bring down that interest rate. So that's an option in your financing selection. And then finally, the term of your loan can influence the interest rate. So generally, the shorter my term is, the lower my interest rate can be. Now, we're going to meet with you to design a comprehensive home buying plan for you. So if you decide to take those next steps in home ownership and really kind of discovering what it could look like for you, we're going to figure out the right product design and what interest rates look like based upon the current market. But that hopefully gives you a better idea of how interest rates are made up. Now, credit's the biggest driver of that for product selection and interest rates. So one of the things we like to do in our classes is to go a little bit deeper and talk about credit. And all of us in tonight's class probably have some monitoring system that you're using for credit, whether that's through Credit Karma or through the credit agencies like Experian, Equifax, or TransUnion. There's probably some tools that you're using. I think it's important to understand, though, there's different credit score models that are out there. So what you see in your monitoring tools is going to be the credit card model. If you apply for auto financing, it's going to be the auto model. If it's on the mortgage side, it will be, of course, the mortgage model that we'll use for qualifying for financing. So TransUnion, Experian, Equifax, they all have different kind of risk calculations and how they assess a credit score. So that's why you're going to have 3 different scores. Now, every loan product has a minimum credit score, and you can see those on screen here. So for the FHA product, 580, for the conventional loan, 620, and then, of course, the VA loan for our veterans, and then the first-time buyer program, which we'll spend some time talking about this evening. Off to the right of the screen, you can see the weighting of the FICO score calculation. So 15% of the FICO score is going to be how long have I had credit. So the more mature or seasoned my credit file is, the higher my credit score could potentially be. 20% is going to be how much new credit am I trying to get access to? So do I have a lot of inquiries on my credit? Am I opening a lot of new accounts? That has a 20% weighting on my score. Now, let's talk about inquiries for a second. So one of our differentiators in our process is we always start with a soft credit check versus a hard inquiry. And the reason why we do that is because soft inquiries don't impact your credit score. And many of our first-time buyers that I work with, they're not going to start their journey towards homeownership maybe a year or 2 years down the road because, we're still kind of mapping out a plan. And so the soft inquiry allows us to get access to the credit to better understand where you're at credit-wise, but not impact the score in a negative way. All right, the next kind of weighting is the amount of utilization or amount owed for your revolving credit accounts. So that's 30% of the weighting. So simply put, we're looking at the balances that are taking up on your credit limit. So if I have $10,000 in credit limits, $5,000 in balances, then I'm going to be at 50% utilization of credit. Now, the optimal level of utilization is 10% or lower. So that means I would want to have my balances at $1,000 or less. If I'm going a little bit higher on the utilization scale, let's say I may be at 80 or 90% utilization, I would encourage the client to get at least below 50% to help get that credit score improved. Now, let me give you a quick tip on how to manage utilization of credit. So when you take a look at your credit card statement, there's actually 2 important dates on that credit card statement. One is the due date, which we're all aware of, but the second most important date is the billing or statement date. And why I want you to kind of take a look at that billing statement date is because that is the date at which the credit card issuer is going to send out all the information to the credit agencies. So here's my tip for you. If you can get in the habit of paying down your credit card balances or paying them off before that billing or statement date, what's going to happen is you're going to bring down that utilization a little bit lower. It's going to give you a much more improved credit score. And if you're paying it on your due date, that's okay. However, you're just not taking advantage of that lower utilization and improved credit score. So if you can kind of change that up a little bit, pay by the statement or billing date, that'll be a much lower utilization for you. Finally, payment history is the last weighting of the credit score. That's how we paid our bills. Late payments are rated as 30-day lates, 60-day lates, and 90-day delinquencies. So the more severe on that spectrum I am on my credit delinquencies, the bigger impact I'm going to have to my score, especially in the most recent 12 to 24 months. That's going to be the most impactful to your score. Now, bigger events like bankruptcies, short sales, collection accounts, those are going to have a bigger impact to your score. So we want to just keep that in mind, but especially in the most recent 12 to 24 months, those are going to hit your score a little bit higher. Now, if I had a late payment back in October of 23, now I'm still inside of 12 months, but as I get further away from that date of late last payment, should see my score start to improve over time. Now, some clients will choose to close out revolving accounts because maybe they just don't want to have access to that credit card, or they've had a bad experience for that credit card company. I would just be mindful that when you close out credit card accounts, just be careful, because when you close out that account, it actually closes out all the history on the credit bureaus with that relationship. And if those credit cards are one of your longest standing relationships, it could impact your credit score negatively. So just be aware of that before you close out an account, because it can hurt your length of credit, but also can hurt your utilization, because that's one less credit limit that you have available to yourself. And finally, with financing, looking at credit scores, we take the middle score of all three agencies. So what that means is, if my top score is 740, let's say my middle score is 720, my lowest score is 700. From a financing perspective, we're going to take the 720 score from a qualifying standpoint. So that's going to impact my loan product option. It could impact my interest rate, my mortgage insurance that I could potentially pay. So all those things will be centered around that middle score. Now, if I decide to apply with my partner, and let's say my partner scores are 700, 680, and 660, well, the middle score between the two of us is 680. So as a lender, we have to use that lowest middle score if you're going to apply with your partner. And then, of course, again, like I said, that could change the product, interest rate, maybe even the cost of mortgage insurance. Now, we want to provide you with kind of a matrix on delinquent items and how long they'll stay with you on your credit. Now, again, it's going to be the most recent 12 to 24 months, but the impact, or I should say the impression on your credit report, will be for how long is listed on this matrix. So, bigger ticket items, so to speak. So, collections, bankruptcies, those are going to be on your report for 7 years. If you have a hard inquiry, it's going to be the most recent 6 to 12 months that it could impact your score, but it'll stay with your credit report for the next 2 years or less. All right, before we get into student loans, I just want to make sure, do we have any questions from the audience about some of the content we've reviewed so far? If you do have any questions, you can just drop them in the Q&A or the chat function, and then we'll get a chance to answer those on air. And it's okay if you don't have any questions right now. I just want to make sure that we've given you a lot of material so far. I want to make sure that we're good. Let's talk a little bit about student loans. And I do realize a lot of our clients have student loan forgiveness, which is great. And at the same time, some of us may not have that student loan forgiveness, so we might be in repayment statuses. So with that said, in loan financing, we do have to take a look at what student loans look like. So if you're in forbearance or deferment, we still have to count a minimum payment against the qualifying for the home financing. So it kind of looks like this. So if you're applying for conventional financing, we'll generally use 1% of the aggregate balances for your monthly payment to budget for with qualifying. Now, if you're in an income-based repayment amount, so let's say, for example, we have $75,000 in student loan debt and we have a $250 income-based repayment amount, I can use the $250 payment for qualifying. All right. Now, if I'm doing an FHA loan and I'm not in an income-based repayment amount, then I would use 0.5% of the total balances. So that would be like a payment of $375 versus a conventional loan would be at a $750 monthly payment. So I think it's really important to understand that even if I'm back in school, maybe I'm working on my master's program and I'm in deferment, if I'm applying for home financing, I still have to count a minimum payment for qualifying purposes. Right. We had a couple questions that came in the chat, so let me just take a quick look. And so let me just kind of, we had one of our audience members want us to kind of expand a little bit on what discount points are. So discount points, again, are additional out-of-pocket costs that you can pay to bring down your interest rate. So usually one discount point is 1% of your total loan amount. That 1% out of pocket will generally equate to about a 0.25% reduction in mortgage interest rate. Again, in today's market, I'm not a huge fan of doing that, just given the fact that the break-even mark's about 3 to 4 years. And yes, you will get a copy of the recording. That'll be up on our YouTube channel tomorrow. So question is, rather than closing out credit cards that we no longer use, what do you recommend? So I think, if you don't close out a credit card, well, let me back up. You can certainly close out a credit card. I would just be careful that it's not one of your longer standing credit cards, because if you close out that account, then it's going to change. In fact, the history that you've had with that that reports to your credit report. So I would just kind of do an assessment of like how mature all of your other accounts are, and if you're not really impacted by that, then I would say it's okay to close out the account. But it really will kind of just depend on the seasoning of those accounts that you're considering closing. All right. And then another question in the Q&A was, would the buyer be able to add the student loan to the mortgage? So unfortunately not. So you can't, when you purchase a home, you can't add any additional debt into the mortgage. So the mortgage can only be used to finance a percentage of the sales price. So generally the highest we can go is 97% of the purchase price, which that's a great segue into our next section, which we're going to talk about programs. And so you can learn a little bit about that. So speaking of 97% of the sales price and financing, that has to do with a conventional loan, which is our first loan program topic. So conventional loans are going to be under Fannie Mae, Freddie Mac. You heard Freddie Mac with our calculator earlier. Fannie Mae and Freddie Mac has oversight of about 70% of all home purchases across the country. So it's obviously a popular product. They set guidelines for how we basically administer these programs across our communities across the country. The minimum down payment using one of their products is 3% for first-time buyers, up to a loan amount of $766,550. So that's called the conforming loan limit. That loan limit is reset every year based upon cost of living and overall housing data across the country. Now, there's markets across the country that have higher cost of living. So, our neighbors in LA or Orange County or San Diego, or even some of the Bay Area markets, we can take those loan amounts up to 1149, which is 1.149 million. However, the down payment when we go beyond this conforming limit elevates from 3% to 5%. So that's called high balance loans. So if you go beyond that conforming limit, it's a high balance loan. And those loan limits are set for different parts of the country. If you're in Virginia, for example, Virginia has a high cost of living market that you can go up to that 1.149 mark. So that's the conventional loan program. FHA is the next program. That's a government insured loan, minimum down payment of 3.5%, up to a maximum loan amount in San Bernardino and Riverside County of $644. If you're in LA County, the maximum loan amount $766,550. So FHA has slightly lower loan limits in certain counties. So depending on if you're going to use that product, it might look a little bit different. It is a government insured loan. It is under FHA, which is the Federal Housing Administration, under HUD, which is the Housing and Urban Development. So all those guidelines are set by FHA. Minimum down payment, again, is 3.5%. Now, you also have high cost of living markets that you can use the FHA product with. So if I'm going to purchase in LA County, you can go up to the 1.149 million. That down payment, which is a little bit different than the conventional product, remains at 3.5%. In just a minute, we're going to do a quick comparison in looking at mortgage insurance on a conventional loan versus an FHA loan, so you can kind of draw some comparisons. And as we meet with clients to decide what works best for them in designing their home buying plan, the conventional loan or FHA loan could be one of those options. Now, the VA loan is for our veterans that have eligibility under the VA guidelines. It's a zero down payment option. Has a lot more flexibility to better support the veteran in homeownership. So things like what we call debt to income ratio. So your payments versus income, a lot more flexibility there, flexibility in credit scores, all to help support veterans in homeownership. So again, it's a zero down payment option. There really isn't a set loan amount for the VA product, although most of our veterans are going to be probably financing $1 million or less using the program. And then we have the USDA product, which is for clients that want to purchase in more kind of rural areas. The benefit there, it is a guaranteed loan from USDA that allows you to borrow with zero down. It can also be complemented with some of the first-time buyer programs. It follows the same conforming loan limits. And then finally, there's the jumbo loan program that allows clients that need a little bit more financing support, that's beyond maybe Fannie Mae loan limits, to be able to finance with a jumbo loan. The difference is those minimum down payments elevate pretty significantly. They go from 10 to 15% down payment. And there's also additional assets that are required in a jumbo loan. Not only do we need to save up for our down payment and our closing costs, prepaid items that we talked about earlier, but you also need to save up for what we call as reserves. And reserves are additional funds that I have left behind after I've contributed that down payment and closing costs. And for the most part, jumbo loans are going to have at least 12-month reserve requirement. So if I have an $8,000 monthly payment and I have a 12-month reserve requirement, then I probably need another $96,000 in additional assets. Let's talk a little bit about PMI. So PMI stands for private mortgage insurance, and there's different forms of mortgage insurance. And so I want to kind of dive in a little bit deeper and talk to you a little bit about conventional mortgage insurance, as well as government insured mortgage insurance under the FHA mortgage product. All right. So if you think about the conventional loan that we just reviewed, if you have a situation where you're putting less than 20% down, you will incur mortgage insurance on a conventional loan. Now, there's different payment options for mortgage insurance. You can pay it monthly. You can take some of that premium cost, pay some of it upfront monthly, some of it or upfront, pay some of it on a monthly basis. You can completely buy out the mortgage insurance. That's called single premium. You can also do what we call as lender paid mortgage insurance, where you elevate the cost of your interest rate in order to buy out the mortgage insurance. Now, PMI is insurance that in essence covers the lender against default. And PMI stands for private mortgage insurance. So we're using outside private companies that will essentially insure the loan. And they have different criteria that goes into the makeup of what their premium will be for your PMI. It includes credit score, down payment, and ultimately how much you finance. Now, most clients that elect a conventional loan and are doing mortgage insurance, they're probably going to elect the monthly mortgage insurance option. The reason for that is because it has a cancellation option in that once I reach 2 years in my home and I have 22% equity, I can apply to have the mortgage insurance canceled. So let's take a quick little look at a conventional loan scenario using mortgage insurance. So if we have someone that's financing, let's say $450,000, I have a 740 credit score and I want to put 3% down, my mortgage insurance costs are about $183 per month. Now, for those of you in tonight's class that have been doing some payment calculations on Zillow's site or Redfin, you probably have seen a bit higher of a mortgage insurance premium. And just the reason for that is because those aren't calibrated correctly to what actually the lending costs look like in mortgage insurance. So that they may look like $300 to $400 a month. So I think it's really important to understand that as you're looking at home buying options, the mortgage insurance is really not as expensive as you might have thought. Especially if we can elevate our credit score or we can increase our down payment, that mortgage insurance cost can come down. Now, on the other side of the equation is the FHA mortgage insurance. So that is government insured. It's a government insured loan. With FHA loans, there are two forms of mortgage insurance. There's monthly mortgage insurance, which is 0.55% of my total loan amount. And there's upfront mortgage insurance, which is 1.75% of my loan amount. And that gets added into my total amount financed. Now, different than a conventional loan, FHA does not have a cancellation option. So really the only way to exit mortgage insurance on an FHA loan is to refinance out of the loan. So let's look at our same $450,000 loan amount scenario. So we take the 450, we have upfront mortgage insurance, which is 1.75% of my loan amount. So that gets added on to my loan. So that's $78.75. And then my monthly costs are about $206 per month. So slightly higher in monthly cost than the conventional loan, certainly much more expensive on the upfront because of the upfront PMI factor. And so as you're kind of taking a look at those scenarios, you may think, well, I would never probably do FHA because conventional is so much cheaper, right? And you're absolutely right. But at the same time, we got to figure out what the right design is for you because not all clients that we work with can qualify in the conventional loan product. FHA is going to have a lot more flexibility in terms of credit score. If I had that late payment in October of 23, that might limit me in the conventional loan space where it might be a little easier to qualify for FHA. So, we want to kind of partner with you to design a home buying plan that has the right product fit for you. And certainly conventional or FHA can be one of those matches. Let's talk a little bit about income as it relates to like employment. And I want to kind of talk about different scenarios that we come across in working with home buyers. I want to first give you kind of a document checklist. So as you're thinking about getting on the path towards home ownership and you need to bring together some documents, this is generally what we ask for: the last 2 years of W-2s, last 2 years of taxes if you're self-employed, last 2 months of bank statements, last 60 days of pay stubs. So those are generally the documents that we would have to compile. Now, from an employment perspective, we generally look for 2 years of work and or educational history. And so what I mean by that is if I can show my educational background, so let's say I graduated from UC Riverside in the fall. I was spent 4 years at UC Riverside with I got an accounting degree, and now I just started my job. Well, I can use that 4 years educational history to basically qualify me for my mortgage financing. So 2 years employment and or educational history. So it's a little bit of a kind of a misconception in the market. A lot of clients that come to work with me think that they need to have 2 years on their job, which just really isn't the case. Now, where 2 years work history gets a little bit more challenging is if I have dual employment. So let's say I work for one employer for 30 hours a week, another employer for 20 hours a week. Then in that case, I do have to show that I've been working with both employers simultaneously for the last 2 years. Even with part-time employment, if I'm in a part-time job, that would also show that I have to been on that job for 2 years. But if we're starting full-time employment, we can basically use that income right away. Even situations for job transfers. Good example is we have a client moving out from Colorado, purchasing in California. She's set to start her job in October. Well, even though she's not set to start until October, we can still close her home financing this month because we have an executed offer letter for her that we can use to basically qualify the income. So, there's ways that we can help best support you in kind of designing your home buying plan and, of course, assessing your income in the situation. Now, the last thing I want to kind of touch on here is that if you have other sources of income in your household, like let's say your partner is contributing to your household, but your partner is not going to be part of the application, in order to count that income, that additional income, that person would have to be part of the loan application. And then finally, let me just kind of touch on self-employment income. So with self-employment income, you do have to show that you've had your business taxes filed for 2 years. So whether I'm a sole proprietor or S corp or C corp, we do have to show that we have 2 years of tax filings. Same thing would hold true if I'm maybe driving for Uber or Lyft on the side. Maybe I have my 40-hour work week job, but I do some additional work with Uber. In that case, to count both sources of income, I have to show that I've been doing both jobs simultaneously for 2 years. Okay. Any questions on income before we kind of transition here to our debt to income ratio conversation? Okay, all right. Obviously, if you have any questions, you can drop those in the chat or Q&A, and I'll get those answered for you. We're going to stick with the theme of income, and that as it relates to income versus expenses. We call this debt to income ratio. It's a really simple calculation that takes into consideration what my gross monthly income looks like versus what my monthly expenses are. So let's kind of take a look at what that looks like. So if I have a scenario here, and by the way, the expenses that we're going to consider there is going to be things like the new house payment, personal loans, student loans, credit cards, auto loans, things of that nature will be all factored into payments. So in this formula here, if you look at the top, I have principal and interest, which is my mortgage, the property taxes on my new house, homeowners insurance. If I'm buying a condo or a townhouse, maybe I'm buying a new home development, I might have HOA or homeowners association expenses. So let's assume that we have $2,500 a month in this scenario, and my other debts are like $500 a month. I'm going to take that $3,000 in expenses versus my $8,500 in income, and my debt to income ratio is 35.29%. Okay. Now, from a qualifying perspective, we can have that debt to income ratio go as high as 43 to 45, in some cases 50%. The question I get asked often is, what should my debt to income ratio be? And that really varies for every client that I get a chance to work with. But what I've found in working with thousands of buyers, usually the comfort zone is about 33 to 36% debt to income ratio. So we can stay in that range. It feels pretty good from a qualifying perspective. But really, for us in designing home buying plans for our clients, we have really two big goals for you. We want, one, this to be super affordable for you. So we want you to be able to afford your home. And two, we want this to be sustainable. So if things change financially for you, you can still weather the storm and still continue on home ownership. So that's kind of what we look at, really. I mean, so debt to income ratio is just a metric for qualifying. It's not necessarily an affordability index. All right, so we had a question in the chat, and before we move on to our next topic, which is if we spent 2 years pursuing a master's degree, would that also help our income, or is it best to wait 2 years to pass with full-time employment? So really the education won't really change anything from a qualifying perspective. We'd have to really look at what the full-time employment looks like. So if you do have an offer letter for your new job, then we can certainly factor that into the equation. All right. Thank you for the question. All right, so we've kind of gone through credit. We've talked a little bit about income, programs, credit. We've kind of designed this plan for us as part of tonight's class. And the last stop in tonight's class before we talk about kind of the process is to talk a little bit about assets. And, there's really two big challenges for homeownership that I find for most buyers. And one is it could be on the credit side because maybe we're a little bit overextended or maybe we have a little bit of student loan debt. But the other side of it can be just savings for homeownership. So in this segment of our class, I always like to spend some time talking a little bit about savings plans. Before we go there with savings plans and talking about assistance programs, I just want to give you a sense of the typical documents needed in verifying assets. Well, you generally need things like checking and savings accounts for the last 60 days. You can use retirement accounts, 401ks, 403bs, IRAs. I would encourage you to talk to your financial or tax advisor before you access those assets so we don't create any tax events for yourself. Gift funds can also be used in home ownership, and that's where a family member is helping support you with down payment and closing costs. That happens quite often, especially as first-time buyers. And there's a process for that where the donor completes a gift letter and we kind of document the transfer of funds. So those are all certainly options in contributing towards your down payment and closing costs. Well, when we think about savings for home ownership, that can be one of the biggest challenges for us. And we're going to talk about first-time buyer programs in a bit, but I want to give you kind of a quick little tip on how to build savings for yourself. Because as I meet with clients and we're kind of building these plans, the payment might not necessarily be the challenge, but it's like, how do we figure out down payment and closing costs? So let me give you kind of a tip on how to do that. So if you're looking at your budget on a monthly basis and maybe you're paying, let's say, $2,000 a month in rent, right? But after getting a chance to meet with us, you realize that, hey, I think I can afford $3,000 a month. That shouldn't be too big of a stretch. That's $1,000 leap in monthly payment. However, I'm having a hard time with savings. So what I would change in kind of how we manage our finances is if we can kind of start budgeting ourselves at $3,000 a month. So when we're making that monthly rent payment, rather than spending the additional $1,000, we're taking $3,000, $2,000 is going to our rent, the other $1,000 is going straight to our savings account on a monthly basis. And it's doing a couple things. Obviously, one is it's growing your savings account. So at the end of 6 months, we're at $6,000. End of the year, maybe we have $12,000, not including interest. But I think what it's also doing is creating that discipline and that habit of getting used to paying $3,000 a month. Because as you saw in our budget calculator, like it's going to be a good sized jump when we get into home ownership. So to start preparing yourself for that budget, I think would be a really good approach for yourself in building savings, but also getting accustomed to that new budget. All right, so assistance programs can also support you on that path towards homeownership. I know most of our audience is probably from California, so we get a chance to partner with CalHFA as the leading provider of assistance programs. So our team provides the most number of assistance offerings to buyers across California. So we partner with CalHFA, which is the California Housing Finance Agency. They're based out of Sacramento, but the agency is designed to support low to moderate income households. You may have heard about CalHFA in the news. We've helped facilitate the Dream for All program, which we're busy funding right now. We don't know if that program will roll again in the future. I know Governor Newsom has talked about other changes to the Dream for All possibly for 2025, but we're still kind of pending state budget funds for that. So stay tuned on that. But the programs that are available with CalHFA that are always constant are the MyHome and the ZIP Assistance Program. The MyHome Assistance Program provides up to 3% of your sales price for your down payment on a conventional loan. If you're going with an FHA product, it's 3.5% of the sales price in assistance. So as you learned in our loan program section of tonight's class, is that would actually fill the gap for your minimum down payment for qualifying. So if you used one of these first-time buyer products, really, we would have our down payment solved for. The only thing we would have to worry about out of pocket would be like closing costs to purchase our home. Now, if we do need more resources for closing costs, there's also the ZIP Assistance Program. And ZIP stands for Zero Interest Program. So what it is, it's a zero interest loan that the state provides you up to 2% right now of your loan amount to cover some of the expenses like closing costs. Now, with the ZIP program, it's an add-on to the My Home Assistance program. So when we elect a first-time buyer program, there's a set interest rate for the first mortgage by using the My Home Assistance program. So for example, today interest rates were at 6% on the My Home Assistance program, which is really a lower than market rate by about a quarter to a half a percent. But the zero interest program, you can add that on if you need additional expenses covered. But right now in today's market where rates are still a bit elevated, the ZIP assistance program doesn't always make as much sense, but the My Home Assistance can be really a huge support mechanism for first-time buyers. So if we were to look at a conventional loan scenario, and we have one on screen here, of buying at $450,000, if I was to traditionally purchase my home, I would need my minimum down payment of 3%, plus closing costs and prepaids of about 2 to 3% of the purchase price. So if I was to purchase right now without a first-time buyer program, I probably would need somewhere around 22 to 27,000. Okay, purchasing at 450. Now that might be a bit of a stretch for most of us, and it might have us on a target goal of maybe 2 or 3 years from now. However, if we were to add in first-time buyer programs, that might make it more of a near-term goal. So if I take that same $450,000 sales price, if I added in the My Home Assistance, that would provide me up to $13,500 in assistance. And now my out-of-pocket expense is maybe $10,000 to $12,000 to purchase versus the 22 to 27. And then if I also need additional support, maybe I add on the ZIP assistance. But most of our first-time buyers will elect the My Home Assistance to get the benefit of a much lower interest rate on the first mortgage and make that out-of-pocket expense much more manageable for them. And again, the CalHFA, My Home, and ZIP assistance is always around. It's always part of the agency's budget. So, it's something that we're very familiar with, and it's a really great tool to help first-time buyers. There are minimum eligibility requirements. First of all, you do have to be a first-time buyer, which is someone that hasn't owned a home in the last 3 years. There are minimum credit scores on each product. So the FHA loan has a minimum score of 640, while the conventional loan is 680 for moderate income buyers, 660 for low-income housing buyers. The debt-to-income ratio that we talked about is 45 to 50%. One of the unique things with the CalHFA product, we only look at the income for the applicant, not the total household income like most first-time buyer programs do. So if I make, let's say, $100,000 a year and my spouse makes $100,000 a year, maybe we're combined over the income limits. But if I just apply just in my name, only my income is counted towards the income limits. Most programs in the first-time buyer space are going to be up to 80 to 100% of the median income for a market. One of the differentiators for the CalHFA product is it goes up to 150% of the median income. I'll show you some income limits in just a bit. And it can be used for a variety of different one-unit properties like single-family homes, condos, townhouses, even manufactured homes, as long as it's on land that is actually owned. If we look at some of the Southern California counties, this is what the income limits look like for the program. If you're joining us from some of the Northern California markets, if you're in the Bay Area, some of the income limits go as high as 300,000, Sacramento markets in the 220 to 230 range. So a much more expansive, more inclusive income limits to help more families across California. And as an expert in the CalHFA product, if that's something that piques your interest, we'll help design plans that can help support you using that resource. So we're very well skilled in that. Let's talk a little bit about the buying process. So as I'm kind of, taking notes in tonight's class and thinking about, I'd like to be on this path towards homeownership, let's kind of talk through the workflow of buying a house. Because, a lot of buyers get confused on, where do I go from here? So first of all, the output of tonight's class will be to get connected with us for a consultation. And that's where we design a home buying plan for you. It's about a 30-minute session with me over video. And then as we design the framework for your financing, we'll hopefully be in a position where we can issue what we call is a pre-approval. And a pre-approval gives you a certificate that you can now start presenting offers to sellers. Now, whether that's this year or maybe next year, at least you have a baseline of numbers with a pre-approval. Now, the pre-approval is good for 60 days, but we can always recertify it anytime. So I have clients that have been shopping for homes a year or 2 years. So there's no really urgency around that. You need to kind of obviously take time to find the right home that works for you and your financial plan. Again, this pre-approval can be recertified at any time. So we get pre-approved at step one. Step two is going to be the house hunting phase of the process. That's where we get a chance to maybe start our online search. We identify some neighborhoods or communities that work for us. We would then want to partner with a realtor generally, that you can work with to find the right home that also will help present offers on the home, maybe negotiate prices of that home. So a realtor would be somebody you would partner with in step two. Now, I just want to make a quick side note here on realtor partnerships. So as you may or may not have heard, there was a settlement with the National Association of Realtors on how commissions are paid to buyers agents that represent buyers. So, we're about 2 weeks into the changes of the real estate law. And so commissions paid to buyers agents that represent you as a buyer have to be pre-negotiated. Okay. They're either negotiated with the seller or negotiated as an expense with you. So, before you decide to partner with a realtor, I would encourage you to have that conversation. Obviously, I'm not a realtor, so I'm not an expert in that, but I would just say, that's something that you would want to have that dialogue with a realtor on. But I encourage you to use a realtor. They should be experts in the market. And we have a vast network of preferred realtors that are really skilled on first-time buyer programs, and we can certainly connect you with someone whenever that time is right. So question on the chat, I just want to answer this really quick, which is, after 3 years of owning a property, if one wants to buy a property again, can they be considered a first-time buyer? So great question. I should have brought that up in the first-time buyer section. So you're a first-time buyer as long as you haven't owned a property as a primary residence in the last 3 years. So let's say, for example, I owned a home in New York for the last 4 years, but I've been renting in California for the last 3 years as a renter. So because I haven't lived in that property in New York in the last 3 years, now I'm considered a first-time buyer. Okay, so thanks for asking that question. I appreciate it. Now let's kind of continue down the process. Let's say I go out and look at homes and I find a home I love and I make an offer on the house and that offer is accepted. Well, then I'm going to move to step 3 in the process. That's called entering escrow. That means I have an agreement with the seller and the seller said, yes, I'll accept the terms of your offer. And now we start the escrow process. Usually from the accepted offer phase or milestone to when we get our keys to our house, which is obviously the most important day, it takes about 30 days on average in the industry. Now, we have ways that we go a little quicker. We can go 21 to 14 days if we need to really get a competitive offer together for our buyers. So there's ways that we can kind of speed things up. But rule of thumb, it's usually about 30 days. Now, within a couple of days of your accepted offer, you as a buyer are generally required to make what we call an earnest money deposit, which is a good faith deposit of usually 1 to 2% of your overall purchase price that counts towards your total out-of-pocket expense. Now, the day we get acknowledgement that your offers get accepted, as your lender, I'll give you a call and say, congratulations, you have an accepted offer. We'll kind of talk through the timelines of your transaction and then get you scheduled for a follow-up video session, which is a 30-minute session with me to kind of reaffirm all the financing numbers. Where are we at from a rate perspective? What does payments look like? How are we feeling about, the milestones that we're going to go through? All those things we're going to discuss during your follow-up video session. It also kind of kickstarts the lending process where we order the appraisal of the house. Your realtor will order inspections. And in California, in most parts of the country for that matter, there's a thing called a contingency period in your contract, which allows you to do your due diligence in the process, which entails getting the house appraised to make sure the house is worth what you're buying it for, get your house inspected, and then finally get your loan financing completed. So all that happens usually in the first 14 to 17 days of the contract. Why that contingency period is really important is because it protects your deposit. So if something goes sideways with your financing or maybe the appraisal has some struggles, you can exit the contract with the seller and be able to get a full refund of your deposit. Now, as we move through this workflow, step 4 is going to be the administrative task of the financing. We call that the processing and the underwriting of the loan. We're going to verify your assets, employment information. We've probably locked in your interest rate, or at least talked about strategy of locking in your interest rate. Interest rates change by the minute, so they can actually change daily on other programs. But there's some strategy, especially in today's market, which you've heard more about interest rates earlier, a when to lock in your interest rate. So we'll strategically work with our clients on when to lock in the interest rate. That's something I think we'd be considered experts at. We watch the market really carefully on a daily basis. And then finally, step 5 is your loan approval. So that's where we get a chance to issue your loan approval. Your appraisal is probably back by that time. And it gets us about 3/4 of the way through the process, which includes the end of your contingency period. So if you feel comfortable with all the investigative work you've done on the house, then you can sign off on your contingency. That tells the seller that you're ready to move to the final stages of the process. And in doing so, as your lender, we're going to issue to you your final closing disclosure, which gives you a 3-day waiting period or cooling off period before we get to the very final milestone. And that's called closing your loan. And that's really the one in-person process you have to do in the whole lending workflow, because everything that we send to you throughout the process is all done electronically. But at step 6, you're going to be signing docs in front of a public notary. And those documents include like all your loan documents, some of the escrow and title paperwork. The signing procedure for that takes usually about an hour or so. Also on that same day, you're going to deliver your final funds for the closing of your home loan. And after all those funds are reconciled by the escrow officer, including the loan funds and maybe assistance funds, then items get recorded with the county recorder's office to transfer ownership to you, which is called a grant deed. And also a deed gets affixed on the house, which is basically the agreement for the loan. Once all that is confirmed, then it's the most enjoyable part of my day. I get a chance to call you as the new buyer and say, congratulations, you're a new homeowner. I got a chance to do that like 2 or 3 times this morning. And it's the best feeling for the buyers and obviously for me too, because now you've made it through this whole process. And hopefully it's been a great experience for you. We're here to help support you on this journey because, like I mentioned, as we launched into tonight's class, this is probably going to be one of the biggest investments you decide to make or biggest financial decisions you make. So when we get to the finish line, we want to celebrate right there along with you. Now, if you're thinking about moving forward in the process, so after attending tonight's class, you want to help build your own home buying plan, we'd encourage you get connected with us for that free consultation. It's a free service we provide. It starts with building an online application for yourself. We only do a soft credit check. You'll upload proof of income and asset documents, and then you'll get a chance to meet with me for about a 30-minute session to design that plan. And as we walk out of that plan, we have all the framework built for your financing. We set some goals and objectives for home ownership. In fact, here's kind of what that free consultation looks like. We're going to look at, where do I want to buy? What do interest rates look like today? Do I have any credit improvement items that I can take a look at and help you with? Our assistance program is a good match for you, and just kind of outline a whole comprehensive plan for you for home ownership. And again, whether you're going to buy this year, great. If it's going to be a year or 2 down the road, that's okay too. We have graduates from our classes that, are in different stages of buying, and we want to just make sure that we can help support you with all the tools and resources you need to achieve that financial goal. Now, we have other resources that are available to you, like our mobile tools. You can do calculations through mobile. You can follow the progress of your application, and also kind of just get a good sense of like what's your application doing, what's different calculations look like. So when I'm out home shopping, maybe I see this home that I love, I want to kind of run a payment calculator. You can do that all through mobile, of course, available on iPhone and Android. Well, as part of our partnership with the UC Riverside Alumni Association, we pass along a discount of $750 in origination cost to you. Now, if you're enjoying this content, you want to share this with friends, family, coworkers. We also have other partnerships across the country that also provide a similar discount. So we would encourage you to share this information with those in your network. And this is all my contact information. So as we're getting ready to wrap up tonight's class and kind of diving into some Q&A, I want to provide you all my contact information. You have some questions after tonight's class that get missed, feel free to reach out to me, message me at any one of those options. That would be great. We'd also encourage you to follow us on some of our social channels. We're trying to provide a really good information to our community on home ownership. So you can follow us on Instagram. And as I mentioned earlier, our recorded version of tonight's class will be up on our YouTube channel tomorrow morning. All right. Well, I appreciate you all hanging in there with us for tonight's class. I want to open it up for some Q&A. I know I've taken a few questions throughout the class, but want to see if there's any questions that our audience has that we can answer. So feel free to use the chat or the Q&A function, and we'll get those questions answered for you. Okay, let me just take a quick look. Okay, so one question in the chat was, is mortgage insurance the same as homeowners insurance? So no, it's completely different. Homeowners insurance is going to insure your home against different perils like, burglary, fire, maybe flood, perhaps. But mortgage insurance is insurance for the lender. So PMI, private mortgage insurance, which we kind of talked about later. This is all recorded, so you can kind of do a look back on what we shared earlier. And of course, we'll have the slides there for you to reference as well, too. All right. Thank you for the question. Okay, awesome. Thank you for that. Just want to make sure I didn't miss anything. Okay. I think we're doing pretty good here. Okay. I think we've got all the questions that, let's see, we got one. Okay. Okay, one question that popped in the chat, which is names on a deed never, okay, so I think the question is, my name's never been on the deed, never actually owned, but can we still buy if we have an equity loan? So you generally can't be on an equity loan unless you have some type of ownership interest on a property. So I kind of probably want to know a little bit more about that on how you're on the equity line. Um, um, Oh, okay. Your name is on the deed. Okay, so if your name is on the deed and that's your primary residence, then you're not considered a first-time buyer, but you can certainly buy again as a second-time buyer. And let me know, and we can talk about that offline, maybe if I'm missing something there. But yeah, if your name is on the deed, then that would just exclude you from first-time buyer programs. And if you haven't lived in the property, then in the last 3 years, then you would be considered a first-time buyer. Okay. So we asked for us to expand a little bit more on DTI. What's attributed to this for approval? So DTI again is the debt to income ratio calculation. So that's your pre-tax income versus your monthly expenses. It's just a guideline that's set by Fannie Mae, Freddie Mac, and FHA. So we just generally don't want to see those expenses exceed more than 43 to 45% of the pre-tax income. You know, as high as 50% on exception. But to my point earlier, most clients are feeling pretty good if debt to income ratio is around 33 to 36%. And during a home buying consultation with us, we're going to show you what your debt to income ratio looks like. But as I mentioned earlier, affordability is really what we're looking at, but debt to income ratio is just a metric for qualifying. All right. Okay. 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 Okay, and then let me just and then the one question we had in the chat was, do you go over other down payment assistance programs during the consultation, or is it just CalHFA? So no, we go over all eligible down payment programs. Now, if there's specific city programs that you're looking at, I'll have to kind of maybe do some more research, but we will look at other programs depending on your eligibility. I will say CalHFA is the lowest priced first-time buyer program out there in terms of interest rate offering, but no, we can certainly look at other DPA options for you as well during your consultation. And we'll look at other products too. We got to make sure that we have the right product fit for you based upon your goals and objectives of homeownership. All right, thank you for that. All right, any other questions from our audience? I know you guys had a lot of great questions tonight. I really appreciate that. Okay, well, if we missed anything, please get connected with us after this session. Again, we'll get you the recorded version up on our YouTube channel tomorrow. We'll get you all of the presentation material, and we hopefully get a chance to connect with you in the future to design your own home buying plan. Have a wonderful evening. I look forward to connecting with each of you soon. Have a good night.